These two homes have the same lot size, same bedroom and bath statistics, on the same street in Vaughan. This one sold in February. This one sold just a couple of weeks ago, and it looks like a price correction of $380,000 in a month. Hey guys, Jordan from Pre-Condo here. Haven't done a market update in a while, and I wanted to today because things are slowing. So the real estate market in the GTA is slowing. That is no surprise heading into more rate hikes and mortgage rates. 5-year fixed mortgage rates at 4%. That's obviously going to pump the brakes a little bit on our real estate market. But it's interesting watching how we're kind of seeing it cool from the outside in. Obviously, none of us expected 20-30% year-over-year gains forever. That's obviously not sustainable. Today, we're gonna go through some numbers and jump through some stats so I can help you make sense of what's going on out there. If you haven't already, go ahead and subscribe and like this video, and let's jump over to the PC and I'll walk you through some stats here. Alrighty, so the first thing I wanna talk about is sales volume, because I'm already seeing headlines talking about, sales volume's down 20-30%. And while that is true, on a year-over-year basis, kind of important to remember that last year was the highest sales volume year ever in Toronto's history for sales. So it's kind of like comparing, Like obviously sales volume is going to be down. It's the best. It was the previous year was the best year ever. So if you kind of look here, it kind of puts things into perspective here. So you see 2022's March here is still higher than 2020 or 2019's considerably. So our volume is still up considerably. It's just down from last year. What I really want to focus on here is the inventory trend, right? So if you haven't heard of months of inventory before, it's a simple distillation of if we are in a seller's or buyer's market. If you have 2,000 listings on the market and 1,000 sell in a month, you have 2,000 divided by 1,000, you have 2 months of inventory. Anything below 3 months of inventory is considered a seller's market. Anything, 3 to 5 months of inventory is a balanced market, and above that is a buyer's market, right? So obviously we've been in a seller's market for both condos and freehold for quite some time. Condos were in a bit of a balanced market for a period in COVID when they dipped, 5 to 15%. But obviously since then, condos have been doing amazing. If you look here, you'll notice that in the past few weeks, we've seen months of inventory start to trend up. It's a combination of a couple of things. So number one is seasonality. Obviously, you have more listings coming to market. Number two is you have a lot of exhausted buyers, and now we have rate hikes, right? So buying power is being hit considerably. People are playing the wait and see game, whereas, a few months ago, they were just desperate to get into the market. So you're seeing a combination of more inventory as well as less buyers or less serious buyers. And as a result, there are freeholds that previously, you go back 2 or 3 months ago, they would have got 10, 20 offers, and now they're only getting 2 or 3. Or in some cases, they're not getting any offers and they're having to relist at the price they actually anticipated rather than underlisting to create a bidding war. And so you're starting to see a lot of terminations and relists, especially in the freehold space, but we are seeing it a bit more in the condo space as well. So to give you some perspective on these numbers, right? 1.1 month of inventory for the condo market is incredibly low. For example, Miami is in the best condo market they've seen in decades, and they're currently sitting at 2.9 months of inventory, which is down 74% from their year prior. And all the brokers down there are, screaming about how crazy of a seller's market it is. Well, Toronto has less than half the inventory of that, but it is worth noting the trend, right? It's not just about the number, it's about the trend. If you were at 0.75 months of inventory and suddenly you're at 1.1, from the perspective of a buyer, that changes sentiment a little bit more than if you were at, say, 2 months of inventory and you go to 2.2, right? On a percentage point basis, that's a significant change in inventory. And here's a chart of the overall listings. So again, like I said, more inventory on the market. But if you look, so the blue line is the amount of resale listings for all housing types in the GTA. And if you notice here, we've had sort of a steady increase in inventory from January of this year, but it is worth noting that it's roughly comparable to April of last year, the same time April of last year. Now, not as sharp of an uptrend in inventory as we're seeing now, but in terms of gross number of inventory on the market, roughly the same. So seasonality is definitely a function. It's definitely a part of the equation here, but it's not the whole picture. So let's talk about the detached versus condo price gap in the 416. So in Toronto proper, what we saw last month in particular, so the March stats from the Toronto Real Estate Board here, you'll notice that, we've seen the highest price gap between detached and condos going back to 2017. Obviously, everybody knows what happens there, and it's actually a good thing to note. I should probably talk about it a little bit more. Freehold, in 2016, freehold really ran, right, in price all across the GTA. And as a result, condos kind of stagnated, kind of the same thing that happened through the tail end of COVID there. And as a result, we got to this place where the average detached property in the 416 was $1 million more, right? You can see here $1 million more than the average condo. And of course, over a long enough time horizon, markets tend to revert to the mean, meaning that there is an acceptable sort of price difference or ratio that people are willing to pay for a condo versus a townhome versus a detached. And if those values get out of line over time, then they tend to correct. And you can kind of see that. So mortgage stress test comes into play. And then, of course, buying power gets reduced by regulation, right? And as a result, people suddenly can't afford those detached, and they start to pivot into condos, which were a really good deal. And if you remember, 2017 was one of the best year for condos ever. In the core, they ran 20 to 30% depending on the building. At the same time, York detached, Peel detached corrected 15, 20% in some cases, while condos downtown did incredibly well, just a function of buying power being reduced. Now, we were right at the same point. In fact, we were higher. We were at a $1.2 million price difference between a detached and a condo property just a couple of months ago, and it's starting to correct downwards now because, the average detached in March in the 416 is down to 1.92 million, which is down from almost 2.1, so 2.07 million. And the average condo is up to $831,000 from $822,000. So a modest increase in condo price, a modest correction in the detached average price. And of course, 1 month isn't enough to see a trend. You can kind of see here over time, months dip, and especially with averages, you have large sales or small sales really skew the average. But we can start to see that trend sort of correct here, right? And I'm anticipating over time we'll see it correct more. And like I said, the function here was buying power was reduced artificially through regulation. Well, the buying power here is being reduced as well. Not so much artificially, but just because mortgage rates are up, right? So 5-year fixed are at, almost, in some cases, posted over 4% now. And, variables are still at 2%. So most people are opting for variables, in my opinion, rightfully so. But it's insane to think that, an $800,000 mortgage just a few months ago at 2% or 1.5% was a $3,200 payment, 30 somewhere around there. An $800,000 mortgage today at today's 5-year fixed is more like $4,100. So that's a huge reduction. You got to remember, people aren't just buying a home based on price; they're also buying based on a monthly payment, and that monthly payment is changing considerably now. And so people are going to change their behaviors as a buyer. In that context. Next up, we're looking at the average selling price of a CO1, meaning a downtown Toronto condo, just sort of the core neighborhoods there, versus a Durham detached. The reason I like this chart is if you go back a long time, you can kind of see that CO1 condo, and I mean the long time, like before, this chart only goes to 2015, but if you go back to like 1996 all the way through 2015, you'll notice that they're very close in price, meaning a Durham detached has historically been pretty close in price to your CO1 downtown condo. And then, of course, COVID totally changed people's buying behaviors. Everybody wanted more space, work from home, didn't need to be so close to the office. The net benefit of living in an urban area when everything's closed just isn't there. So there's a number of reasons why that changed. And of course, you see, it looks like a Bitcoin chart. You just see the price of a Durham detached skyrocket, while condos dipped, recovered, and sort of traded sideways. But in the last month, Durham detached are down 9% on average, and Toronto condos are up a modest 6% on average. So you're starting to see, again, mean reversion of the market. Do I think this will continue? I don't know. I think over a medium to long term, yes, this chart will continue to narrow. However, in the short-term horizon, I think the frothier, like what you're seeing with the prices starting to correct, and I'll hop over to Habistat to kind of show you this. Sales price by region. You can notice here, February through March and April, for most regions, we're seeing and this is for detached properties only, we're seeing a decline in price, in median price. This is median price, not average price, right? So not skewed by large sales type of thing. So you can see here, we're seeing a decline. In particular, you can see Peel here doing pretty terribly. Toronto not faring so hot, and Halton's doing all right. Durham kind of corrected and then plateaued, it looks like. But I imagine you're going to start to see a little bit more correction in the frothier markets. And it's just a function of, look, I mean, if you have an asset class that ran 60% in the last 2 years over COVID, and now you have an increased borrowing cost with mortgage rates, I think it's insane to think, if those mortgage rates stay where they're at today or push from 4 to 5% and stay there for a couple of quarters, I think you're going to continue to see the froth chopped off for the more, let's say, the more elevated markets, right? And here's just the Durham detached price ratio to the downtown condo as a ratio. So you can kind of see, like, historically it's around 1 to 1.1, right? So a Durham detached is 1 or 1.1x the price of a Toronto condo. And then, of course, we had a few really good years for condos, dipped down to 0.9x. And now we're sitting at our height. We were sitting at 1.6, meaning a Durham detached averaged 1.6 times the price of a Toronto condo. And then, of course, with last month's numbers, we're seeing Durham detached average down and Toronto CO1 condos average up 6%. So you're seeing that ratio start to correct here. Now, there are some comps floating around. So let's get into some specifics. You guys know I love my comps. I love looking at the micro rather than the macro data here. And let's look at some stuff that's been floating around on Twitter. This one in particular got a ton of attention on Twitter, right? Because it looks like, these two homes have the same lot size, same bedroom and bath statistics, on the same street in Vaughan. This one sold in February. This one sold just a couple of weeks ago, and it looks like a price correction of $380,000 in a month. This is why you have to be careful when you look at comps like this. If you pull the exact square footage, which I don't know if that's available to everyone, but it's available to realtors. So if you pull the exact square footage, I found out that this one that sold for more in February is 3,034 square feet above grade, which means it sold for $738 a foot. Now this one that sold for seemingly $380K less is only 2,230 square feet above grade. So considerably smaller, and it actually sold for more per square foot. It sold for $833 a foot, which you would expect on a smaller house. So you're not actually seeing, in my opinion, any form of correction on this particular comparable, but you're also not seeing price acceleration, right? Now, this one was my favorite. So this one floated around, and I think this one actually is a very good case for the bears to look at price correction. So these are some stacked towns in Brampton on Veterans, right? So this one sold about 6 weeks ago for just over $1 million. And then you had another unit sell 3 weeks ago for $950, and then you had another unit sell a week ago for $850,000. So again, it looks like a very quick $150,000 correction on these units. But again, in reality, when you pull square footage, funny enough, when you pull square footage for these units, the picture, unlike this picture, which got a little bit better, this picture got worse. So unit 128 here is 1,254 square feet. So it sold for $800 a foot. This next unit is 1,460 square feet. So it sold for $650 a foot. And the third unit here is 1,396 a foot. So it sold for $610 a foot. So you're actually looking at a price reduction of $800 a foot all the way down to $610 a foot in really 6 weeks or a month period of time. This one's really interesting to me. It is worth noting that 128 had the nicest finishes, right? So it had laminate throughout. These other two have carpet throughout. It had some modest builder kitchen upgrades. I'm not talking anything fancy, just slightly nicer than the other units. Is it worth $150K more? Absolutely not. 40, 50K at most. So this one is showing price, kind of showing the story that a lot of us are saying, we're seeing cooling from the outside in. Then we got another one here. This one floated around, Aurora. Looks like a $200,000 price difference. Won't bore you with the details. They're different square footage. So this one sold for $710 a foot. This one sold for $700 a foot. So again, not a price correction, but definitely not seeing price acceleration in this case. So let's look at some condo comps, my bread and butter. So this one's for Grid Condos by Center Court. This one's right at Dundas and Jarvis, kind of an investor favorite. Here's a unit that sold for $745,000 back in February. And then in March, exact same unit, right, on a higher floor, sold for $765K. So you're looking at, $20,000 in floor premium, kind of exactly what I would expect this unit to sell for. So again, you're not seeing price acceleration, you're not seeing price growth on this particular unit, but you're not seeing any correction either. Next up, we've got Courts This is a Concord building in City Place. Here's a 1-bedroom sold for $775,000, puts it over $1,300 a foot. Exact same unit, 2 floors up, sold for $745,000 in March, and this one was back in February. So, and by the way, this one doesn't have parking. So discount $50K for parking. This one is up in price from February through March. And 100 Harbor, so Harbor Plaza, obviously right in the waterfront by Menke's. This is a studio, 373 square, sold for $575,000 back at the end of January. And then we've got this one at the end of March, selling for $585,000. You've only got 1 floor of difference, so it's up $10K in that period of time. And the final example here, you've got a 430 square foot, 1 bed, no parking, sold for asking price $469,000 back last year, towards the end of last year. And then you have the exact same unit on the 11th floor, selling for $525,000 in February. Also no parking on that. And then in March, you've got it selling for $525,000 again on a lower floor. So in this case, no price acceleration, but no slippage either. So let's talk about some of the stuff we're going to see. Look, mortgage rates, who knows where they're going to go, right? I imagine the next rate hike will be 25 points. Some people are predicting 50. In fact, a lot of the major banks are predicting a 0.5% interest rate hike. In either instance, it will help to cool the market. You know, I know there are a lot of realtors on Instagram and TikTok saying that, you know, house prices never correct and, you know, just buy as soon as you can afford to get into the market. I'm not a proponent of timing the market. If you watch my other videos, you'll know that, you know, I'm a firm believer in the long-term hold as a strategy. But I think it's ridiculous to assume that 4 to 5% interest rates for a sustained period of time is not going to chop the froth off the market. I think the asset classes at most risk for correction are the ones that have appreciated the most in the past 2 years, especially because those tend to be exurbs markets, you know, an hour plus outside of Toronto, people who were betting on work from home in perpetuity. And I think, of course, you know, I've got clients calling me every day. I was called back to the office full time, or I was called back 2 days a week. Some of them, you know, hybrid, some of them voluntary, some not voluntary. I think over time, we're going to see more and more people return to the office. Foreign home buyers, that's been a big topic. So we're expecting that, you know, the federal government is going to announce a 2-year ban on foreign home buyers. It's election season. We're going to see a lot of promises. This one has no bite. The reality is, of the few foreign home buyers, like, look, I sell hundreds of units every year. I've worked with a number of people from Hong Kong. Most of them have Canadian passports. So, you know, they just don't live here, but they are citizens. Or in other instances, you know, students. So if they're waiving this regulation in the case that a student is living here, which is what the plan is, then again, you know, you can't stop foreign capital from coming if they can just buy through their children. And so I don't think this really has any bite, especially when you're looking at, you know, the Ontario reported numbers of, you know, 4% of our home ownership is foreign. And of course, the 15% foreign home buyer tax in Ontario didn't really do anything. So I can't imagine that this will do much either. It'll have some effect, but I don't think it'll be noticeable in the numbers at all. And on my final point of the long-term hold play. Look, if you're looking at, you might be on this channel because you specifically buy pre-construction. In that case, none of what I just went through matters to you because pre-construction prices don't correct as a function of resale prices. Like, let's say, and we saw it, right? So through COVID, condo prices in the core in some buildings dipped as much as 15, 20% for a very short period of time, but they did dip. And new launch prices at pre-construction projects did not. In fact, they went up. And the reason for that is because projects are priced as a function of margin, and land costs are up, construction costs are up, supply chain is uncertain, development levies are up, inclusionary zoning is coming. I have another video on the current state of building a pre-construction and what the pricing is going to look like in the future. I will link that in the description. You can go take a watch if you're interested. But from a pre-construction standpoint, like if you're hoping, oh, the market will correct and I can get a pre-construction condo cheaper for today than you know what my buddy got one for last year in the same neighborhood, it's just not the case. It's not going to happen. Sorry to burst your bubble. But the long-term hold strategy, as far as I'm concerned, is still intact. Over the short term, with a rise in interest rates, I absolutely think things will slow. I think, you know, condos will probably trade sideways for a period of time. I think the frothiest of the markets will see correction. They are already starting to. I wouldn't bet on it. Like if I could short those exurbs markets, would I? No, probably not. The truth is we continue to underbuild. We continue to underlaunch new condo supply. Ford has a plan to tackle that. You know, from what I've read, it looks pretty good. Streamlining, upzoning, streamlining development proposals, all that stuff. But that's a solution for a decade from now that doesn't fix our affordability issues today. And immigration targets have gone up once again. So we're looking at 431,000 in 2022 and almost 450,000 in 2023 and 2024. So over the medium to long term, I'm still incredibly bullish on Toronto. None of this short-term micro stuff really changes my view, but it will be really interesting to see how the rest of the year shakes out. And if you're someone who's on the fence about maybe I want pre-construction, maybe I want resale, I have the ability to do 20% down and close on a resale unit, a resale home or a resale condo this year. Maybe wait out the spring market and see what comes, because there might be some buying opportunities. I will leave you guys with that. If you like this video, like and subscribe, and I will see you guys next week.